I'm excited to introduce to you today Andy Manton, who's going to serve in our manager spotlight. Andy is actually not new to these calls. He's joined us, I believe, twice before. Andy is a unique example where if you followed these calls for the last number of years, we really have to do two things well at OneAscent Investments. We need to allocate well. We need to understand what's happening in the markets and how those things interact and affect each other. And Nathan's going to speak to that here in just a little bit. But the second thing we have to do is find great managers. We've always had an approach to find world-class managers in every category who can integrate their strategy in a values-based way. And Andy is an example of a manager that we found about 3 years ago. Andy was working at another firm, running an international strategy that was world-class. And through just relationship and connecting and through our diligence, we began to use his strategies inside of our solutions here at OneAscent. Well, fast forward to this time last year, roughly, and Andy felt called to join our team. We were using him when he was at another firm, and he now is on our team at OneAscent, and we're so excited to have him. Since then, Andy has taken over some of our strategies that we manage in our ETFs, and just recently, a few weeks ago, about a month ago, we launched an international equity ETF and an emerging market ETF that Andy runs. And so, Andy, I'm excited to have you join us today and to share about international equity investing. Thanks for being with us.
Thank you, Cole. That was a great introduction. And from what Cole just said, if you didn't know me before, I think you probably have a good idea of who I am now. But for those of you that don't really know me, again, my name is Andy Manton. I joined OneAscent at the end of the year last year, as Cole mentioned. And I was previously with another firm called Shelton Capital, where I managed an international and emerging markets equity fund there. And prior to that, I worked with some other firms, some big firms like Merrill Lynch and Deutsche Bank, and some small firms like Victory Capital and WHV Investments. My focus has always really been on global equity markets as an analyst or portfolio manager. And as Cole mentioned, here at OneAscent, I now manage the large cap core ETF and the newly launched international and EM equity funds. And being that we're starting these two funds, we just started them recently. I'm here today really to talk to you about the international investing, international markets, and my investment process. But quickly though, before I jump into that, I just wanted to talk a little bit about why I came to OneAscent. I've been getting some questions about that. And really, it goes back many years now. As Cole mentioned, he was really the first one to introduce me to the values-based investing community a little over 3 years ago. And as I moved closer to the community and started talking to a lot of advisors, I realized that there really was a lot of work that needed to be done, really on the education side. As I talked to advisors, it became clear really to me that there was a clear gap in the direction that a lot of advisors wanted to take their business, and just not really knowing how they're going to do that. So I guess in other words, it seemed like many advisors didn't quite know how to talk to their clients about values-based investing, or maybe felt too separated from the portfolio managers to really understand what they were doing. But to me, that really kind of broke my heart. But I realized, I just wanted to I wanted to help really in a bigger way. I wanted to be more on the front lines with you and your clients. And I've been with secular firms my whole career, which was okay for me. And I knew I was there for a reason. But there was a time last year where I clearly heard it's time. So I put myself out there, and Cole approached me about what they wanted to do here at OneAscent, and it seemed like just a perfect fit. And really, for me, it's really who OneAscent is. It's a wealth management firm. Primarily, and I see it as more of a multifamily office with now an in-house asset management capability. So I'm really excited to be here, and just wanted to share that with you very briefly here. But I'm already digging into a lot of my time, so let's go here. So high level, my investment approach again is very similar to what Cole just went over. I've always kind of done it this way. But the way that I see the investable universe, and no matter what fund that I'm managing, it's always, there's a certain amount of companies, but first we want to take out the companies that we already know are not doing what we want to see companies doing. There's companies that might be harming society in some way. And so we take those out. But then we move into fundamental analysis, where we're looking at companies and trying to get a better idea for really what they're doing, what they're about, and seeing if they make good investments overall. And that kind of gets into the overall assessment of whether or not we want to really invest in them, that we want to put them in the portfolio, and really hold them up as companies that are really what we consider to be flourishing, helping society flourish. But once we have a few of those companies and we have a portfolio, we move into the portfolio construction phase, which consists of portfolio optimization and risk management. And really all the portfolios that I manage are high conviction, usually concentrated portfolios, but portfolios we believe are impacting the world in a positive way. So I want to talk about a little bit about my philosophy overall, something that's a little bit unique, something you might not be familiar with, but I want to kind of tee it up in this way. Over time, everybody that's ever put together a portfolio has always wanted to have a quote unquote diversified portfolio. There's a lot of different ways in which you can think about that. But really, we've gotten to a place today where I think when people talk about an equity portfolio, they'll ask you, okay, what sectors are you exposed to? What sectors are you over or under allocated to? And I think that is fine, but I think there's a lot of problems with that. And this became clear many, many years ago to me. And I set out to kind of do it a little bit differently and really get to the heart of what investing and investors really should be looking at. And really, the way that I see it in terms of sectors, there's really three main problems with kind of looking at a portfolio just through the lens of sectors. The first problem being that sectors more and more are becoming just more arbitrary. There's a lot of these companies out there that are classification specialists, and they'll put these companies into a category or a sector, and a lot of times they can't even agree with each other about where a company should be. And again, it's missing the point overall, but which I'll get into in a second. But the second problem really is that companies have really become a lot more complex. So just because a company might be a technology company or in that sector doesn't mean that they are actually doing something that you would consider technologically heavy. And I'll get to an example of that in a second as well. But there's lots of examples of this, and the point is that it's just really hard to say, okay, so this is a tech company, so now I know what that company does. But even if you did, it doesn't really help you as an investor. So, but the third problem really is that there's just really little useful information that is identified or brought forth by knowing what sector a company is in. It's not that useful to me as a professional investor. So a few examples of what I'm talking about, though. Amazon, GICS, who is the kind of the main classification specialist that most people will refer to when they talk about sectors, puts Amazon in consumer discretionary. And sure, we think about Amazon, what are we going to buy off Amazon today? So it really is a consumer discretionary. But did you also know that it's actually one of the biggest cloud providers? Most of the S&P 500 companies use Amazon in their cloud service. It's a huge part of their profits, maybe not their revenues, but their profits. But they also have food and drug parts of the business, Whole Foods. That's more of a staple, consumer staple. And Prime Video, that could be technology, it could be entertainment, however you want to see that. The point of there is that just by having a label called consumer discretionary does not represent what that company really is all about. And we can go through all three of these. MasterCard, GICS says it's a tech company, information technology company. You might not have realized that, but that's where it sits. Even though the revenue is directly linked to or related to credit expansion and consumer spending. So really what they do is highly complex, and it is a tech company in my mind. People don't really think about it as a tech company, and you really wouldn't put that in the same category as like a Microsoft or something like that. It's very different. So Berkshire Hathaway, GICS says it in financial, even though 25% of the revenue comes from financial companies. The rest of it, 75%, comes from companies that are in very different businesses. And then company we all love to hate, Walt Disney Company. GICS came out with this kind of a random sector a couple years ago, a new sector called communication services, and it's kind of like the place they just put all these companies. They just don't know where else to put them. Basically, is what they're saying. They kind of are saying we're giving up, and we need a catch-all place to put these companies. So that's where Walt Disney sits, and you can think of Walt Disney as a lot of different things now. But communication services, I'm not quite sure I'd put it. I think about it in that context. Instead, what I would submit to you is I think there's a better way to look at the investment universe. What I know is that companies do go through a natural corporate life cycle. Companies start out in one way. If they make it, they tend to grow very quickly. They tend to then decelerate as new competition comes in, or the market that they're in starts to age a little bit, and they might start to going downhill from there into what we call aging, where companies are just growing quite nicely, maybe kicking off some great cash flow, just not producing the returns that they might have once had. And then those companies might, if they're not careful, might fall into what we call the value destroyers category. And those are companies that are not able to use their own capital to produce a return, a shareholder return that is greater than their cost of capital. So they're actually literally value destroying. So this I know is true. And now this isn't, companies don't go through an even life cycle process. Some companies might spend a lot more time in the high growth area, or they might spend a lot more time in the aging part of the life cycle, but they do naturally go through a life cycle stage. And to me, knowing where a company is on this life cycle spectrum is critically important. It's so much more useful as an investor if I have this information, because I know then if a company is in the high growth stage, for example, I know what questions to ask that management team. You've got some great advantages now, you're producing great returns. How are you going to stay in that stage? How are you going to keep those advantages? How are you going to maintain the types of returns that you are now producing? How long is it until somebody else comes in and competes with you? It's questions like that. Or if I'm looking at an aging company, those are very different questions. You've got great cash flow. What do you want to do with it? Is this just going to be the way it is going forward, or are you going to try to reinvent yourself, take that cash flow and buy something else, or should we just expect a big dividend going forward? Those are kind of the questions that are true for every company all around the world. These questions can be asked, and I would submit to you again that there's only 5 companies in the world, 5 types of companies in the world, and this is really how an investor should be looking at a company. This kind of takes the product, the service, the widget, if you will, out of the equation and says, what, that's a secondary concern. What's more important to me is how good the management is, how good the business plan is, and can they execute on that business plan? And that's really at the heart of what drives shareholder value. It's not the widget, it's how the business plan is executed, and understanding what that looks like on the investment corporate life cycle. So really, there's 3 steps to the process again. The first part is we go through the entire universe and we quantitatively assess each company and put each company into one of these 5 stages on the corporate life cycle. And this is really based on the company's return on investment. So using the company's capital, what is their returns on that capital been over recent history? And then also their asset growth. How much are they growing compared to the rest of the universe? And that really helps us put everything into one of these 5 buckets. The other part of that quantitative process is that we have a screen that we use. It's a multi-factor screen with factors that are different for each stage in the life cycle. We know that each stage is unique. We know there's different factors that are affected at each stage. And we apply a quantitative screen to every company depending on what stage they're in. So this gets us an expected return for every company in the universe, and we focus in on the top 20% of that screen, basically, to go after ideas. Those are the top 20 names that we feel are the most capable of outperforming going forward. So really the bulk of our time is spent in step number 2. It's the fundamental analysis stage. We do a lot of valuation analysis. We have an internal proprietary DCF that we use. We spend a lot of time understanding the valuation drivers of every business. We do a lot of management interviews to, again, understand the business plan, understand what we think their capabilities in executing that business plan might be. But this is where we spend most of our time. I'd say 95% of our time is right in step number 2 here. And then step 3 is again, the portfolio optimization and risk management phase. This is ongoing. This is looking at the risks in the portfolio. Every actively managed fund has risks. The question is, which risks are you comfortable with, and how is it going to change over time, given what we're seeing around the world, economically, business cycle wise, et cetera. So this is something that I do as a PM every day. That's kind of the philosophy. It's a little different. So if anybody has any questions about this, that was a very quick way to go through that, but we'd be glad to talk about that a little bit further if anybody would like. The other question I've been getting a lot with just given how the markets have been going is, why should I be investing in international markets at all? I mean, the U.S. has been killing international markets over the last 10 years plus now. Why do we even bother? And it's a good question, and I've been trying to answer that for the last couple of years. 2 years ago, really, I did a webinar on this, actually, and the 4 points or 4 myths that I presented there really are true today, and I just want to go through those really quick. But I think that it doesn't prove anything, but I think it'll get everybody thinking a little bit differently. But the first one is the obvious one. U.S. stocks always outperform international stocks. Myth number 1. It's not true. International stocks have actually outperformed 3 of the last 5 decades, if you look back in history. So I know at the end of a cycle like this, and by the way, these cycles tend to last about 10 years or so. This one's been extended a little bit because of COVID and the fiscal and monetary help that we've gotten here in the U.S. But typically these cycles are about 10 years. But also what's happened over the last 10 years is a very strong U.S. dollar. That's been a trend, and that's really helped push more assets into U.S. stocks and bonds, but U.S. stocks so primarily. It is not true. International stocks have outperformed before, and have done so in the last 3 of the last 5 decades. The second myth is that the best businesses and CEOs in the world are in the U.S. I think, sitting here in the U.S., we always hear about these great companies, very innovative companies. We naturally think, well, they must have the best managements in the world. There's just some great homegrown talent here. True, there is, but it's not true that they only are here in the U.S. There's a lot of great companies, and I've had the privilege of knowing a lot of great CEOs over the years outside the U.S. And I'm excited to kind of bring that to you, even introduce you to a lot of those companies, because there's a lot of great things happening outside of our borders here. But just to show this and highlight this, Harvard Business Review does this study once, I think it's every 2 years. And this is back from 2019, so pre-COVID. But in their study, they basically look at CEOs all around the world, and they say, okay, of the CEO's tenure, what has been the stock return over their tenure? And there's some constraints. They have to be there a certain amount of years. But basically, the results were that 37 of the top 100 CEOs were in the U.S. So that means that 70%, a little over, of the top CEOs or CEOs that are producing the most shareholder value are outside the US. And that says a lot, given how good the US market has done, right? So, if you look at the top 20, only 9 are US based. So more than half are outside the US. And by the way, most of those CEOs, those 9 CEOs, are in the tech industry. So when you think about how tech is done, just from a stock point of view, it's not surprising. But you know, the correlation between tech prices and CEO talents, might not be that strong. So anyway, myth number 3, I get this a lot. So the European economy is lagging, and it could be any economy. Take South American economy, any economy. But the question is, the European economy is lagging, so there's really no need to invest there, right? Well, that's kind of a belief, I think, that's universal, but it's missing a little bit of the point. And to highlight this point I'm going to try to make about this is that when we looked at the top 100 European companies by market cap, and we looked at where their sales exposure is, only 39% of their total sales exposure is to the European economies. So really over 60% of their sales exposure is outside of Europe. So it's not exposed to whatever is going on in Europe. So the point there is that there's some great companies that are doing good things, but aren't necessarily beholden to whatever the economy or economies do there in Europe. So they could be selling things here, they could be selling things in Asia. There might just be some good companies domiciled in Europe that are selling everywhere else in the world. So just because it's located in an economy that might not be that good doesn't mean that we should not invest in that economy at all. And by the way, only 35 of those top 100 companies cross the 50% mark. It's an interesting stat there. The last one is that the U.S. market has been the strongest because it's been the healthiest. I think that's kind of something that we're just kind of born and bred to understand and realize that we are the best. Where the economy here is just great and it's been healthy. But I think that we forget that we've had a lot of help. Interest rates have been artificially low for the last over 10 years now. We've been in a period of quantitative easing since 2010. That's been the reason and the driver of those low interest rates. But that's been extremely helpful to U.S. assets, whether you're talking about your house or bonds or stocks. So that has really helped over the last 10 years, and it has been a huge driver in everything that we've seen. But I would ask, do you think that's going to last? Because it's obviously already reversed, and I don't know if it's going to reverse again to the extent that I think equity holders wanted to here in the U.S. So in other words, this period of QE and artificially low interest rates may be over. So something to consider. One other thing too, the corporate tax cuts that we had in 2017, those really helped to extend this cycle in a big way. People don't really realize this. There was a lot more after-tax profits, but I think what the tax cuts were hoping, I think Trump was hoping, and I think economists were hoping a lot of that would be kind of driven back into, those profits would be driven back into the economy, into capital spending, R&D, those types of things. The truth is most of that went into buybacks, a huge amount, almost all of it, in fact. So that was a huge tailwind for stock prices, and I'll get to that number in a minute. But when again, just to kind of highlight the disconnect here, corporate profits actually fell 17% from 2014 to 2019. This is pre-tax corporate profits. Most people don't know that either. Now, it looked good from an after-tax earnings perspective, but corporate profits pre-tax actually fell in that period. So something to just be aware of. Another point, between 2009 and 2018, the S&P 500 companies spent 4.3 trillion on buybacks, or 52% of net income. 4.3 trillion on buybacks. That number is staggering, and obviously a huge part of the overall capital flow over those years in the U.S. And by the way, 30% of those buybacks in recent years have been made with debt. So companies adding leverage to make those buybacks. And by the way, total corporate debt has doubled since 2011. So we're looking at more levered companies, hugely susceptible to rollover risk. And so what I mean by that is, when that debt expires, you pay it off, and then you try to issue more debt if you can, but you're going to do so at a much higher cost. So that's something that companies, countries are now coming to realize, and it's going to be a huge risk over the next few years. So all of this is just kind of pointing out, you know what, this has helped a lot in the past here in the U.S., but this time might be over. You know, the corporate profits taxes rather are going to go up. We know that. So that tailwind might stop and reverse, actually. Buybacks are now talked about as being taxed. You know, Congress is going to make it a little bit more difficult, and there just will be a lot less cash to go around for buybacks, I think. So that tailwind, again, it might not be there. So all this to say that, you know, we should be looking to diversify. We should be looking elsewhere. And when I look at international markets, there's some great companies out there. They're so much cheaper than they are here in the U.S., and they are overlooked. So that is definitely the reason that we should be diversifying away from the U.S. Into other markets. So I just wanted to go through a couple of examples real quick of companies that I've invested in over the years. Some great companies I've had the opportunity to get to know well. But one is a bank in Indonesia, Bank Rakyat, and some of you have heard me talk about this last week, actually, at our conference, which I really loved spending time and meeting a lot of you there. But just to go through this again real quick, in Indonesia, they have a government-sponsored microloan program. Some of you might be familiar with microlending in general. It's sometimes a difficult subject. It's very nuanced, and there's different ways to do it. But Indonesia has really figured this out, I think. And what they do is they have a government-run program, but they partner with banks to really administer and do the lending for this program. And it is a fantastic program, and I think they've just nailed this idea of micro lending. You know, what they do is essentially they cap the interest that you're allowed to charge lenders, which kind of takes care of that problem that you see in a lot of different countries of predatory lending, and lenders really trying to take advantage of the borrowers. So that problem is solved with this program. The other problem is that you know, given that you've got that cap, and ultimately the bank might want to go out there and lend to whoever they can. There might be a problem with loan losses, and that might be a big risk for the banking sector in general. But it turns out that first of all, the government will cap these losses for the banks. That is one of the guarantees. But it turns out that if you do this the right way, the borrowers pay back. And you know, Bank Rakyat's loan loss ratio is about 3%, or has been lower too in years. That's amazing for an emerging market bank that is lending to very small lenders, or lending to very small borrowers. So anyway, the bank has been a phenomenal success. It's averaged an ROE of over 21% over the last 10 years. But more importantly, really, when you look at the poverty rate, so this program has been going on for over a decade now, but when you look at the poverty rate in Indonesia, it's gone from 82% in 2009 down to 50% as of last year, according to the World Bank. that's a huge staggering number that so much poverty has been alleviated from that country because of this. It's not the only reason, but it's a big reason. This bank has got 31 micro and ultra micro borrowers. So they touched a lot of lives and really gone a long way to solve that problem. Another company is Ambu in Denmark. There's a problem with reusable scopes. Scopes, when you think about when you go in for some kind of ENT scope or a colonoscopy, something like that, those scopes that are being used are primarily reusable scopes. You go in for procedure, they're clean. After you're done, they're cleaned and they're used again tomorrow. There's a lot of infection risk. Ambu has kind of solved this problem with creating this single-use scope, and it's been a huge success. Now we're out of this investment now, but when we had it, it was a huge success for us. We made over 400% in that stock. So another company that we've owned over the years was more of a what we call a value destroyer. This is a company, it's a turnaround story, and it's kind of a boring auto parts maker, but they've completely redone what they do, refocused the company and totally restructured their company, and it really had to do with a management change they made in 2009. But a very inefficient company went from a very efficient company and changed their focus from really having no focus to focusing everything they do on lowering the CO2 output in automobiles and how do we help them do that. And then now they're refocused again on cars producing no CO2, so the electrification of cars. So this kind of story in moving from producing just product to helping society, helping what they do for a living, helping cars become more efficient, has been a great story. But this value destroyer, which once was a value destroyer, has produced an investment return for us over 600%. So I'm running out of time and I can't really go into it more, but if anybody has any questions about any of these companies, there's a lot more of them out there. Be glad to talk to you about any of these. But I think that's it for me. One other thing, as far as the new strategies go, they're not new. I've been running the emerging market strategy now for over 2 years now, but the international strategy has been going on for 13 years. But this track record starts with my days at Shelton, and it's over 6 years now, I believe. So the top one is the emerging market strategy. That the top number is ours in blue there. The bottom number is the index number. So quite a good differential there. And then the international is below that. And the index is right there as well. So again, any other questions anybody has, be glad to talk about any of this offline as well. So thank you for your time.